the cost of capital is simply the weighted average of those three. And of course, the after-tax part matter for the debt because interest expense is usually tax deductible, and that deduction lowers the cost of the debt. So the way you reflect this is you multiply by the pre-tax cost of debt, 1 minus the tax rate. And this tax shield is one of the reasons why leverage can increase firm value. We'll see that in a bit. Now there is another thing that we can mention in this slide, which is the idea of pecking order in financing. And firms will prefer to use internal financing like return earnings because it's cheapest and it doesn't send any signal to the market. So the first preferred one will be internal financing, then it will be debt because it's usually cheaper than equity, given that debt has seniority, as we saw earlier. Debt holders get paid before equity holder in case of liquidation, for example. And then there is the issuance of equity that is the least preferred method because first, well, you need to issue it, and this has a cost. And second, because it sends a signal that management is saying, you know, we cannot get cheap debt. I mean, if you could get cheap debt, why would you issue shares? So that's why, another reason why equity is least favored.